Hello. Greg Rand, Chief Strategy Officer of Renters Warehouse, Steve Katz, Executive Vice President and Chief Investment Officer of Residential Financing at Arbor Realty Trust, and Brian Murphy, Senior Vice President of Residential Financing at Arbor Realty Trust, are here to share insights on the state of the single-family rental market today. They'll discuss recent trends, promising investment opportunities, and the differences in acquiring versus building SFRs, among other key topics from day one of the IMN SFR Forum West in Scottsdale, Arizona. It's part of Arbor Realty Trust's recap of the IMN conference. I'm Betsy Kim, Assistant Vice President of Editorial Content at Arbor. Many thanks to our guests for being a part of this Q&A.
Thank you for having me.
Thanks for having us, Betsy.
Yes, thank you.
Well, now, Greg, can you state what you see as the state of the single-family rental portfolio investment market today?
Sure. It's actually a great place to be talking about it because this conference happens every 6 months, and we've always kind of seen it as a benchmark. I always come into this with my radar up to try to see if anything new is jumping out at me, and we're still kind of early into the show right now. And so the first thing that's striking me is the new faces. All right, the volume of people that are at the show and the people that I have not met before. There are new large owner operators that are coming in for the first time. There are new entrepreneurial level people that are growing, people that only ever wanted to have 50 houses are now trying to make their way to 250. The whole thing has created a food chain that everybody has a chance to get bigger.
Steve, what are some of your observations?
To rally on what Greg said, we're seeing from the multifamily side many large operators in the space trying to get what they call small homes, as opposed to the large, say, 20-plus units stepping in, buying portfolios or buying them one at a time and accruing them. And that's exciting times. As cap rates gets driven in on the multi side, we're seeing real opportunity financially to pick up some yield from the multifamily sector.
And Brian?
I think, some of the trends are basically the build-to-rent sector becoming front and center here at the conference. In years past, it was, more about the fix and flip, perm loans, financing, et cetera. Now, as opportunities, wane in some areas, build-to-rent is definitely more in focus than it was in past conferences.
Well, Greg, following up on some of Brian's observations, what are some of the trends that you've been seeing recently?
That's a good question. Recently, the businesses, the service providers in SFR had become more and more, and it's still happening, becoming more and more the center of the spotlight. So, for example, early on, it was the big groundbreaking operator owners, companies that were raising the first $1 billion to buy, crossing over the 10,000 unit threshold. It was almost all centered around this unprecedented volume that was taking place, and the fact that the asset class was now being blessed as an asset class in the capital world. And over that period of time, companies, and I've been part of this, that were servicing those big players, the big players who were trying to do things that hadn't been done before, needed entrepreneurs and innovators to create technologies and services to help them do it that were really special purpose products and services for specific clients. And then a lot of people woke up and said, hey, this is pretty good for everybody. Like this technology or this tool or this service is something that's actually scalable and could be offered to people at all sizes.
So, Steve, do you agree or disagree, or do you have some other thoughts on the recent trends?
No, I agree. And to rally off what Greg said, we're seeing a migration into the more institutional financial products. We've seen mom and pop having 1 or 2 homes. We're seeing guys with 10 or 15 products. They finance these properties with a series or an amalgam of local banks. We're seeing the institutional financing that Arbor provides becoming more and more standard, more CMBS-type financing. With that, we'll be able to issue securitizations that bring more investors in, and you're seeing the market grow and grow. As the financing gets more sophisticated, we expect to see more and more institutional players start to really step into the space.
Brian, let's bring you in this conversation. What do you think some of the reasons are behind these trends?
Well, I think it's the fact that, the market has evolved over the last, 6, 7 years since the financial crisis. As Steve mentioned, it's kind of become an accepted asset class in the capital markets. That has helped bring down rates. And there's just, a plethora of opportunity with millennials and many demographics not wanting to own. It's just the opportunity to become a landlord is greater and greater.
So does anyone else have any thoughts about the reasons behind some of these recent trends?
The asset class is proving out, right? I mean, it had never been under, you could call the Wall Street microscope before, right? So people knew that you own a rental property, you make a profit. And if you ask most people how much you make, they say $350 a month. They didn't know what a yield was. They didn't know what a cash-on-cash return was. It wasn't measured that way overall until it was being done at a large scale. Now you've got quarterly reports coming out from the biggest players, and we know that people are pushing the envelope on what kind of net operating income they're able to achieve. We're able to compare that to multifamily and other food groups in commercial real estate. So I think it's matured to a point where people understand that it's not a fad. It was born of the housing crisis, but that's not the reason why it exists today.
If you think of the housing market at large, the second largest fixed income market in the world is U.S. housing. An enormous portion of it are rental, whether it's multi or single family. But if we look globally where rates have come, they've come crashing down to really lows in our lifetime. And the ability to create yield in the single family rental space is still alive and well. So when you see on the one side entities like Blackstone coming in multi-billion-dollar lots, new entrants talking about putting $1 billion in, and then you have the mom and pops that own 2 going to 3 going to 4. There's an enormous group in the middle that is trying to figure out, how do I grow my portfolio? And that, to me, is what's really driving the technology changes, the property management changes, and the efficiencies in the market, is that there's so many buyers, there's so many people willing to spend and deploy capital in chasing of this yield.
So, Brian, what SFR portfolio investment opportunities look particularly promising?
I think the opportunities in the build-to-rent space are particularly promising. There's still plenty of product out there, but the easily identifiable assets on the onesie-twosies, that's a little harder thing. So investors these days are, okay, I can't buy them piecemeal. Build-to-rent, that's an easier way to go. You do it in size, and with population growth and just the demand for housing and rentals, I think it's a great way for investors to deploy capital. You kind of, I think, get what you know what you're building. You have a take on what it's going to shake out to be.
Steve, and then Greg, what are you seeing in the build-to-rent landscape?
In the build-to-rent space, you're really meeting the demand curve right in the face. What people want, the millennials and others, want to live in a home. They don't want to buy a home. They rent cars. Some people even lease appliances and TVs. This is what people want. They don't want to have to come out of pocket with the large down payment. So we are providing, if you think what's the comp in these build-to-rent communities, it's really the 3-story walk-up garden-style apartment. And if you can lease it at a similar price or even pay a little bit more, you now have a 3-bedroom unit, you have your own garage, someone showing up on Saturday to mow the lawn, take care of the landscaping. Generally speaking, what we've seen is highly amenitized projects. So there's a park for your kids to play in, there's a gym, there's a pool, there's a social aspect to it, and you still have the privacy of your own home. So I look for really an enormous growth in this build-to-rent space. Arbor's currently participating in the space as a lender. We're seeing a lot of opportunities, some in California, not as much on the coast, but we see big opportunities through Texas, certain locations in Florida, Georgia, and we just think we're going to see more and more of it.
I'll admit that I didn't get it when it first came around. When I heard about build-to-rent, my first question, because I do get it from the standpoint of why would a tenant like it? I get to live in a new construction home I didn't have to buy, right? That was not something people expected could be available. So I get that. What I didn't get is why in a really robust housing market, when a builder can put a salesperson in a model and the houses are selling like hotcakes, why do they need to complicate it? And then I started to understand when I talked to the builders. A lot of builders, their bankers love when they break ground on a 75-unit subdivision and 20% of it is in contract before the first shovel goes in. Bankers love that, okay? The home buyers say, oh, honey, I don't know, what's it going to look like when all the trees are in, Investors are like, we know what it's going to look like. They don't care. They want a little bit of a discount. But for them to be able to get in, the builders like breaking ground. They also like selling the remnants, right? So my 75-unit subdivision, I've got 20 left. They love the idea of getting out, okay? Being able to say goodbye to the subdivision, move their sales group off to some other subdivision and sell the last piece of it. I've also started to see some builders are beginning to realize that the life of a home building company, and I focus more on the mid-size of everything, okay? I'm just always about the mass market. I know a lot of home builders that are always building one subdivision at a time. If it's like musical chairs, music stops, you're in trouble. So if you're in the middle of trying to sell out a subdivision that you bought the land 9 years ago, you got your entitlements, you broke ground, you started building, you're reading articles talking about, is there going to be a recession in 2020? They're nervous about that because they know that sometimes you go bankrupt if you're in the middle of a subdivision and the market turns, right? They're realizing that if they had kept 20% of the homes they built, their life would be very different right now. You know, I know a home builder's been in it 30 years. He's built 2,000 homes. If he owned 400 of them right now, he wouldn't worry about anything.
Well, Steve, can you describe some of the critical differences between investing when acquiring property compared to building SFRs?
Buying units one at a time, you're trying to figure out a local market, figure out local rents. What's the condition of the home? Does it need lipstick or light improvement, or does it need taking it down to the studs? It's different in terms of property management, one location versus another. But in the build-to-rent space, you're identifying key locations, and you can get a slightly lesser quality location, but still desirable from a school perspective. So you can even split one large development where you could have one-third rental, two-thirds sale. You could have 25-75. You can just be more efficient. You could also have carried interest in the way you manage your properties. Whereas in the one-at-a-time acquisition strategy, it takes a lot of time. You have to be patient with your capital.
Final question, bonus round. If all of you want to say what you think is the key takeaway from this IMN conference day one, what is that? Starting with Greg?
I'll say the thing that I opened with, that it's attracting new players in, that people who are, whatever their career aspirations are, finding yourself at the beginning of something that's in the first inning that's massive. I mean, the size of this asset class is unreal. And yet the number of people that actually have any experience or understanding in it is very, very low.
I'd say the takeaway is build to rent is the hot topic. People want to understand it. People want to understand what the cost structure is. How do you not have overruns? Who are the tenants going to be in these developments? Where's the land acquisition opportunity? Are the large public builders coming into this space? What's the future?
The SFR market as a whole is getting the attention it deserves. Technology is coming online, and I think really there's opportunity for everyone.
Well, thank you, Greg Rand of Renters Warehouse and Steve Katz and Brian Murphy, both with Arbor Realty Trust. To our listeners, stay tuned for our post-conference discussion where our panelists will address flipping properties, technology, and the future of the SFR market, amongst other key SFR topics from the IMN West Conference in Scottsdale, Arizona.